Welcome back. Today's session, I'm going to do something unusual, something I try not to do. I'm going to pick on a few investment banking valuations. Generally speaking, I cut investment banks a lot of slack because I understand that valuation in the hands of an investment bank is more sales tool than analytical device, that the objective is to get a deal done. And consequently, I know that asking bankers to follow first principles might be asking too much. But once in a while, though, when I get a chance to look at investment banking valuation, I find it so outrageous that I can't restrain myself. And today is one of those days. A couple of days ago, I got my hands on the Tesla prospectus for its acquisition of Solar City. And embedded in that prospectus were a couple of investment banking valuations that I want to focus on in today's session. And while much of what I'm going to say is about the specific bankers involved in this deal, I think there's a larger problem in acquisition valuations that we've got to come back and address if we want deals to actually make sense. So let's set the table. A few months ago, Tesla, specifically on June 21st, Tesla announced that right after the close of trading, that it planned to acquire Solar City in an exchange of shares. 0.11 shares, or roughly around that of Tesla for every share of Solar City. Now you're saying, what's the big deal? Companies try to acquire each other all the time. What made this deal a little unusual, or a lot unusual, was the fact that both companies were controlled by the same person. Elon Musk is the lead stockholder in both companies, and his first cousin is in fact the CEO of Solar City. Now here's what the companies looked like at the time the deal was announced. Tesla was by far the bigger company with about a $29.4 billion market cap and a $31.4 billion enterprise value. Solar City was a company in trouble. Not only was its market cap down, but it owed a substantial amount of money. It's a highly levered company in a lot of financial trouble. So, not surprisingly, when the deal was announced, there was a bit of blowback as to whether this might comprise conflict of interest to the point that you could not let the deal go through. Well, in the following weeks, the deal continued on pace. On August 1st, both boards of directors, two companies, not surprisingly, okayed the deal, and the FTC approval came a few weeks later, on August 25th. In fact, what makes this particular deal unusual is the shareholders in Tesla will actually have to okay the deal, and Elon Musk actually cannot vote his shares in that deal because of the potential conflict of interest. Now, clearly, the boards of directors in Tesla and Solar City have recognized that this is a deal that's going to come under special scrutiny because of the potential conflict of interest, and they've done everything legally that they need to do to cover themselves. In fact, both boards hired bankers to come in and analyze the deal. Neither banker is one of the big investment banks. In fact, Tesla hired Evercore Partners, a New York-based investment bank, a boutique investment bank, whatever that means. And Solar City hired Lazard, a fairly well-known name, but again, not a Morgan Stanley, not a Goldman Sachs. The reason I bring up Goldman Sachs is Tesla's banker on their previous stock offering was Goldman Sachs, and you'd have expected to see Goldman Sachs on this deal, but perhaps there's a story in the fact that they're not in this deal. So on August 1st, when the deal was in a sense approved, the specifics came into place, which was 0.11 shares of Tesla for every share of Solar City, and if you boiled it down to basics, that would translate into a price of about $2.6 billion, about a 20% premium for Solar City. So, of course, the numbers come out, and there's been a fair amount of debate about this, and the prospectus was filed reflecting it. Now, I'll have to tell you, anytime you have a friendly merger like this one, friendly in what sense both the acquiring and the target company's boards of directors want to go through, the bankers actually face a dilemma. And here's what the dilemma is. The acquiring company is planning to pay a certain price for the target company, right? So it's usually a premium on the market price. So that price is given. The acquiring company's investment bankers now have to convince their shareholders that this deal is a good deal. You're saying, what's so difficult about that? They have to convince their shareholders that what's being paid for the target company is less than the value of the target company. You're saying that's not too difficult, but here's the dilemma. The investment bankers of the target firm have to convince the target firm shareholders that they're getting a good deal as well. And for that to happen, the price paid for the target company has to actually be greater than the value of the target company. You're saying, how the heck can the target company be worth more than the market price and less than the market price? Well, as any banker involved in a valuation will explain to you, the two magic words in every merger help you out. One is control. And why does control help you out? Because you're allowed to add 20% to the price of a target company without consequences. Why 20%? Because that's what everybody does. And there's, of course, synergy. Synergy is the mother lode of being able to explain away even the worst deal, because all you have to do is estimate enough synergy in a deal and add it on to the value of the target company as a standalone company. You can effectively end up convincing acquiring company shareholders that they're getting a good deal, while also convincing target company shareholders that they're not being taken to the cleaners. So as you can see in this picture, the target company's status quo value is actually the same for both bankers. Just for simplicity, I've assumed that they're the same. They don't have to be, but I've assumed they're the same. But what allows the acquiring company's bankers to convince their shareholders they're getting a good deal is the 20% they're adding for control and the additional amount they're claiming for synergy. So that's the typical rule book in any deal to get the deal done. Now, what's particularly difficult in the Tesla Solar City deal is both synergy and control are reaches. Is there synergy? Well, according to Elon Musk, this is a no-brainer. There's tons of synergy, but it's actually very difficult to both see that synergy and actually show it in numbers. Because you have to show it in numbers, you either have to show me economies of scale, cost cuts for the combined company that will show up as higher profits, or you have to show me potential revenue growth that would not have existed for these companies as standalone companies. Now, there's been some talk about how there can be cost advantages here, that by combining these two companies, that Solar City will be able to cut costs, though none of those arguments actually suggest you need to do a merger for this to happen. It almost seems to be entirely a problem at Solar City. And the revenue gains are much more remote. In what sense? I can't visualize a story or visualize a scenario where more people are going to buy Teslas because Solar City is part of Tesla. I mean, what's one got to do with the other? Or more people are going to install solar batteries, solar cells, because they own a Tesla. To me, any argument connecting the two is a real stretch. So the synergy argument kind of is difficult to carry through. Control is even more difficult, because the essence of control is you're telling me the target company can be run better. But if you're already in control, as Elon Musk is, of both companies, why do you need to do a merger to change the way Solar City is run? If you don't like the way Solar City is run, why don't you just fire your first cousin? What's so difficult about that? So in this particular case, I'll concede the bankers had a tough task. As I said, I was willing to cut them a lot of slack. So as I looked through the prospectus, I was able to pull up the numbers used by both bankers here. Remember again that in this case, Evercore is working for Tesla's board and Lazard is working for Solar City's board. And here's the essence of what they need to do. The exchange ratio set on this merger is 0.11 shares of Tesla for every share of Solar City, right? So if you're Evercore, you have to convince Tesla shareholders that 0.11 is really a low number, that they should be really paying much more, 0.12 or 0.13. So Evercore's task is to come up with numbers that will tell you that 0.11 is a low number, that you're getting a good deal as a Tesla shareholder. Lazard's task is the exact opposite. They need to convince Lazard shareholders that the 0.11 is a high number, that Tesla is actually overpaying for them because the true exchange ratio is much lower, 0.09, 0.08, or 0.07. So I knew that this was where they were going. So I took a closer look at how they came there. And the first thing that surprised me, and this is something I'll come back to, is both Lazard and Evercore had very little discretion, actually no discretion, on forecasting cash flows. The Tesla valuation, for both investment banks, was based upon numbers provided to them by the Tesla board. And the Tesla board provided them with two sets of numbers. One from Goldman Sachs equity research forecast for Tesla. Why Goldman Sachs? I'll let you be I'm suspicious, but why Goldman Sachs equity research? Why not Morgan Stanley? Why not Bank of America? But Goldman Sachs equity research forecast for 2016 through 2020 for Tesla. And the second was there is IBES is actually a service that collects analyst forecasts. The second is consensus forecast. I'm not sure of what. Maybe revenues, maybe net income. I don't think IBES forecasts actually provide details on operating expenses for Tesla. So basically, they were given these numbers for Tesla. So both Evercore and Lazard have the same numbers for Tesla for 2016 through 2020. For Solar City, the numbers were provided to Evercore and Lazard by Solar City. Again, for 2016 to 2020, for two different scenarios. One assuming unrestricted access to capital markets, and the other assuming restricted access to capital markets. Again, nothing wrong with what's being with making two sets of judgments, but the numbers are coming from Solar City. That's kind of shocking. If you're doing a DCF and the CF comes from somebody else, it's really not your DCF. It's somebody else's DCF. But let's look at the rest of the assumptions the two investment banks made. Looking at Tesla, here's what Evercore assumed. Evercore assumed a 10 to 12% cost of capital. Everything they give is in ranges. So I don't know why they do this, but in fact, I think I do. But they give a range of 10 to 12%. Lazard's cost of capital for Tesla is 12 to 13%, or at least they meet in one number, so that a high point for one is a low point for the other. So given that the cash flows and earnings are coming from the same sources, the discount rates are one layer where you'll see differences. So you can already see that Tesla is, in the case of Tesla, Lazard is using a higher discount rate than Evercore is. And in the case of Solar City, Evercore is using a higher discount rate than Lazard is. Kind of let it kind of sit in there and think about it. The other number, of course, in this valuation, where they have some discretion, is how they take the 2020 number and make it into terminal value. I'll be quite honest with you. In discounted cash flow valuation, if you're going to do real mischief, it's usually in the terminal value. And if you're clever in your valuation, you can do mischief and actually hide it. These two investment banks didn't even try. Evercore, in estimating the terminal value for Tesla, assumed a 6 to 8% growth rate forever. I don't even repeat it because, bad thoughts come into my mind. 6 to 8% growth in US dollar terms forever. Lazard kind of avoided the whole issue with Tesla. They used to 10 to 18 times EBITDA to get the terminal value. Again, a wild rate, but EBITDA multiple to get a terminal, and they call this a discounted cash flow valuation. So here's what the numbers look like using the Goldman Sachs Equity Research and IBES. For Tesla, Evercore's estimated value is between $89 and $302. Come on. I could have asked the doorman in my building what the value of Tesla is, and he'd probably have given me pretty much an estimate like that. And using the IBES numbers, they get 133 through 451. What incredible advice. In the case of Lazard, the range was tighter. They gave an estimate of 145 to 270. So that's for Tesla. In the case of Solar City, Evercore did bring their growth rate in perpetuity down to 3 to 5%. Again, there's probably a story there. I don't want to tell it. Lazard went back to a perpetual growth model. Why not use a multiple? I have no idea. 1.5 to 3%. According to Solar City, under the full liquidity case, the value of Solar City is about $37.5 to $62. And with the no liquidity case, or the restricted liquidity case, the value is between 25 and 43. Wow. In the case of Lazard, the value in the liquidity scenario is between 1875 and 3775, and with the no liquidity case, 1075 and 20. There's actually a funny story here, because in the first round when Lazard did these valuations, they double counted debt and they ended up with $4 less per share across the board. They found it supposedly and added back the $4. Now you're saying, where's this all going? Remember the end game. If you take the Evercore valuations of Tesla and Lazard, and you divide the Lazard value by the Tesla value, you end up with about 0.124 to 0.699 Tesla shares per Solar City share. So that's what Evercore is claiming a fair exchange will be, about 0.12 to 0.70. All those numbers are much higher than 0.11. So what they're telling you if you're a Tesla shareholder is, oh, don't worry, you're getting a great deal. Lazard, if you use their numbers, and I'm using the midpoint numbers because they actually didn't, I don't think, computed an actual exchange ratio. The number you come up with is 0.0819 Tesla shares per Solar City share. Hey, remember again, if you're Lazard and you're talking to Solar City shareholders, you got to convince them that 0.11 is a good deal. And the way you do it is by showing them that they're getting more than they should be getting. And so both banks have done their jobs. And finally, when you look at the prospectus, they kind of give away the game. Evercore tells you how they're paid. They paid a 1.25 million as an opinion fee. I know bankers are expensive. Well, you can understand that. Plus a 5.75 million contingent on the deal happening. Lazard is getting 2 million from doing the valuation, plus 0.4% of the equity value of Solar City contingent on the deal happening. You think, what does contingent on deal happening got to do with anything? Hey, do you think there might be some bias in this process? Do you think that these two banks want the deal to go through? I've often said that asking an investment banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. What's the answer you're going to get? You're perfect? These guys want the deal to go through. They're showing you the numbers to justify it. The only thing is, they're not doing a particularly good job of hiding their biases. At least try, right? Make it look like you're unbiased. They're not even trying. So the evidence on these valuations is kind of shocking that this is what passes for discounted cash flow valuation. Now, it's true, both these investment banks also throw everything but the kitchen sink as well. They do pricing, they do a sum of the parts valuation of Solar City as if any part of Solar City is divisible from any other part and there are potential buyers for any individual parts. So I took a look at these valuations and I decided to pass judgment. I know I shouldn't be doing this. I'm putting myself in an ivory tower. But I think that there is enough evidence here that we can pass judgment. I'm going to start with what I call the misdemeanors. These are the faults in these valuations that I will pass as garden variety faults. These are the mistakes that I see in banking valuations that are mistakes, but since everybody makes them, maybe you have an excuse for doing it. So here are the three misdemeanors. First is there's absolutely no internal check for consistency. What do I mean by that? When they change for both Lazard as well as Evercore, when they change growth rates, everything else seems to be held constant. You have the same cash flow, the same reinvestment. Your growth goes from 1.5% to 3%. How does that happen? No real business can increase its growth without reinvesting more, without changing its cash flows. Absolutely no check for internal consistency. The second is both bankers throw discount rates at me, 10 to 12, 9.5. They all use buzzwords, CAPM, cost to capital, debt ratio. I'm going to give them the benefit of the doubt that they've actually computed the risk-free rate, the beta, the risk premium, the debt ratio, the cost of debt, right? I seriously doubt it because looking at their numbers, they don't look right. But I'll assume that it's just differences in judgment. But here's what I don't understand. It's okay. You got a 12 to 15% cost to capital for the next 4 years. When your company is a growth company with a lot of risk, okay. But you get to 2021, you're telling me your company is going to be a money-making, profitable, low-growth company. How come the discount rate doesn't change? Why does it stay at what it is today? And finally, these bankers, like most bankers, go back and forth between pricing and valuation. I've already talked about how Lazard valued Tesla. They value Tesla by taking the cash flows for the next 4 years and then applying a 10 times EBITDA. Why is that a valuation? It's a forward pricing. So when you mix up pricing and valuation, you end up with a mishmash that's neither. So I'm going to leave them as misdemeanors because I see these across the board in lots of banking valuations. It's not fair to pick on just these two. Now come the felonies. First, outsourcing of cash flows. I'm shocked that first both investment banks accepted a spreadsheet. Basically, that's what it looks like. Is they were handed spreadsheets by Tesla on one hand and Solar City on the other. So use these numbers in your valuation. You can't outsource your biggest input in a discounted cash flow valuation. The biggest input in a discounted cash flow valuation is not the discount rate, it's cash flows. And the fact that they're coming from Goldman Sachs equity research on the part of Tesla and Solar City itself suggests to me that these cash flows are biased judgments. So you're starting off with raw numbers that are not believable. And the hijinks in the terminal value. I mean, I've talked about the Lazard problem, but 6 to 8% growth in perpetuity, you're saying it's a difference of opinion. If you assume a 20% revenue growth for the next 5 years and I assume 5, that's a difference of opinion. If you assume a 6 to 8% growth rate in perpetuity, In an economy where the risk-free rate is 1.5%, inflation is close to zero, and real growth is 1%, 1.5%, that's not a difference of opinion. That's nonsense. It's impossible. So what's the verdict? Well, as I said, I'm going to pass judgment. I find Lazard guilty of laziness, absolute laziness. Plugging in discount rates into somebody else's spreadsheets and calling it a valuation and signing off on it, it's just plain lazy, and getting paid $2 million plus is outlandish. It doesn't make any sense to me. Evercore's valuations have all the laziness in the Lazard valuations, plus a whole lot of incompetence. You see bad assumptions piled on impossible. These are valuations that suggest to me that the bankers involved in the Evercore valuations either have forgotten basic valuation or they just don't care. Goldman is a mystery here, right? It's the unstated investment bank. The only time it shows up in these prospectuses, in the prospectus, is when the Goldman Sachs equity research numbers magically show up for the Tesla valuation. I'm going to hold back on the verdict because it would be unfair for me to claim things that I don't know, but I do have 3 questions for Goldman. First is, did you guys have any input into the choice of these deal makers? I mean, who came up with Evercore and Lazard? Did Tesla actually pick Evercore out of a hat, or did you suggest to them that they should pick Evercore? Second, those Solar City cash flows that came from Solar City's board, I know there is no way Solar City's board actually worked through EBITDA and cash flow numbers. Somebody did this for them. Did you have any role in estimating those cash flows? And finally, how the hell did your equity research forecast end up in an investment banking valuation? I thought there was supposed to be a Chinese wall between equity research and investment banking. Or is that wall so full of holes that people can climb up the wall and down the wall and over the wall and through the wall? I'll hold off on the verdict until I find out. But maybe suspicious minds want to know. So we've looked at the evidence, I've passed verdict. Now it's time for the sentencing, right? Now, if this were a just world, here's what should happen. At least with Lazard and Evercore, there should be a punishment, right? The punishment should either take the form of legal sanctions, where a court steps out and says, you can't do this, this is incompetence, or loss of business. I have some bad news. I don't think either is likely to happen. On the legal sanctions front, I describe legal settings as the place where valuation first principles go to die. The courts are so bound by respect for history, precedents, and expert witnesses, even when that precedent and expert testimony fails common sense tests, that I don't think they're going to step in and do the right thing. I hope I'm wrong. I hope a Delaware court judge actually wakes up and asks, because I have a feeling this case is going to be litigated, and I hope that they get a judge who actually asks tough questions. Then I'll be glad to supply you with 5 questions that I would like to ask these bankers for free. I know, since I don't do expert witness work, I'd be glad to provide this pro bono. As for loss of business, that should happen, right? I mean, bankers can't value companies. Why would you want clients going to them? I think you're missing the point there. You know why so many bad deals go through? It's because the companies want the deals to go through, because they're spending. The managers of these companies are spending other people's money. In a perverse way, the ineptitude shown by the bankers in this valuation might actually make them a better banker to go to. If you're a company that wants to do a bad deal, you put $20 in a bag, you just paid $55 for $20 in a brown paper bag. You want a banker to sign off a fairness opinion that says that's a fair deal? Hey, looking at what bankers did on this particular deal, I don't think you're going to have any problem. In my experience in this process, ineptitude in valuation usually allows you, it's almost like the more inept you are, the further up in the ranks you rise and the more business you get. It's not just, but it's a reality we face. Thank you very much for listening.